At this moment, let me also welcome on the show Feroze Aziz, Deputy CEO Anand Rathi Wealth, who joins us this morning. Feroze, thank you so much. Feroze, we are talking about all the hits and potential misses of Prime Minister Narendra Modi's leadership over the last 11 years. And one subject that we cannot miss in our discussion today is the transformative tax reform by way of GST. Talk to us, Feroze. This was a long pending reform. In fact, there were so many discussions at one point in previous governments. We used to talk about a policy paralysis, and GST was something which was always in the making. And finally, it took late Finance Minister Arun Jaitley to stitch up all the consensus and present the GST. Now that GST has been around for 8 years, tell us the impact it would have potentially had on foreign investors looking at India and looking at compliance in India.
Karthik, good morning. Yeah, like you rightly said, GST was one of the largest reform. See, GST as a concept was not something which is earth-shattering. What is important is its implementation, getting the states together, getting them on the same page. That was the tough part. And I think that's what has made sure the GST implementation has been brilliant. It had its own hiccups over the first couple of years. And that's where GST has reached a record high, as you're flashing on your screen. April 2,37,000 crores of GST. I remember we having celebrated 1 lakh crore mark just about 5 years back. Now we are speaking about a number which is 2,37,000 crores. See, I think tax collections are a very, very important thing in a country which is running on fiscal deficit. And tax collections on the indirect tax side, which were having several inefficiencies and difficulties for business owners to actually comply as well. That has been simplified. So now if you look at last year, you see the indirect tax collection growth of almost about 11.5% on a large base. That says that your fiscal deficit as a percentage of the tax collection is only 45% for last year. What do I mean by that is most people look at fiscal deficit as a percentage, or 99% of people look at fiscal deficit as a percentage of GDP. But I think if you look at Karthik ka ghar hai, if you are spending more than you are earning, you will see it as a percentage of how much you are earning. If you are spending 30,000 rupees more, you will divide the 30,000 by the salary you earn, take home, and see what percentage, amdani kitni hai, kharcha kitna hai. So that has come down to 45%, which had reached almost about 100% of tax collection in the COVID year. And that, I think, has happened because of GST. Compliance has become easier and leakages have become smaller, and I think we're still scratching the surface. The kind of leakages which still exist and the set-off provisions which are there, which I think those are getting plugged. And I think it'll take another 4 or 5 years, and we will see some astronomical numbers when a country of this size compliantly pays all their indirect taxes.
Is the fact that India's stock markets over the last 11 years have skyrocketed like we've never really seen before. In fact, Feroze, if I remember correctly, Sensex in 2014 was at the levels where Nifty 50 is today. We were looking at Sensex at about 25,000 levels in 2014 and what, 81.5 or something market closing on Friday. We are looking at almost a 3 times growth, in fact more than a 3 times growth on Sensex alone, and a similar story for the Nifty. For the market specifically, what has really worked in the last 10 years?
Karthik, if you rewind 11 years, you remember one of the big foreign investors had made a statement that we are a fragile country and a fragile 5 is why we were counted. But what happens is if there is so much effort coming in from a billion people, it isn't going to be easy for a fragile country to not grow with the kind of entrepreneurship India breeds. And if that gets a good governance plus entrepreneurial mindset, can create value. I think that's where 250, 300 years back, India was controlling world's GDP, a significant portion of that. I think that's what is going to happen if you have so many people, so much demographic dividend, and a great governance can fill it. So point I'm trying to get to is we were fragile 5 to where we are today. Like you rightly read out, Karthik, it has become 3 times. So the Nifty return and Sensex return are close to about 11.8, 12%, which is what in 10, 11 years, you almost make it 3 times. Right. So if you look at it from a perspective of people who have still not invested, which is what is happening, you saw 6 lakh crores of DII inflow in a single financial year. If you go back in FY24, 2014-15, we had an SIP amount of 18,000 crores. for the full year. And this year, last year, we had 2,62,000 crores. So the
Right.
SIP number, that means the retail investor has started using capital markets as a savings instrument and not looking like an investment instrument. Aaj paise dale, kal kya hoga paise.
Right.
So I
Right.
think the retail mindset paradigm shift has happened. And if people are not seeing this data, that an 18,000 crore SIP cumulative number could become 2.7 lakh crores. And if you don't believe this is becoming 10 lakh crores in the next 10 years, 10 lakh crores of SIP inflow alone will happen in India. That's the power of 140 crore people. And I
Right.
think their mindset has changed. They don't do savings in the unstructured market as much as they would. My maid is been doing. My house helps, all of them drivers, all of them have an SIP, and proactively so, not just instigated by me. So
Right.
that's what is happening. The lower strata of India is believing in the capital market because of the stable governance we have had for the last 11 years. And I think we're still scratching the surface if people can't read this data.
For the next 4 years, at least, Feroz, what is it that markets expect from the government? And of course, we have heard about prophecies of Sensex hitting 1 lakh, etc. None of them have come through as yet. But what is it that the markets and the investors, Indian retail investors, DII, as well as the global investors, expecting over the next 4 years?
Yes, Karthik, like you said, you said that we have seen a bull run. I think I'll just take a minute to explain. A bull run's definition in my mind has changed, rightly or wrongly. Earlier bull runs would actually mean pockets of significantly greater IRRs. You've seen 2004 to 2007 bull run was about 35% compounded return on Nifty. We have not seen those kind of bull runs. So the point I'm trying to get is, as the economy becomes more and more mature, the base effect leaves both the economy and the capital market. The base effect leaves. So then you don't see those kind of compounded returns. So a 12% CAGR return for last 11 years, which you alluded to rightly so on the graphics which you've been flashing, those are also bull runs, because as long as you make more than the nominal GDP for the same period, which was 11.04, and your Nifty has given you about 80 basis points more compounded, that's a bull run to my mind. If you get more than the nominal GDP, I think my expectation of the next 4 years would also remain to revolve around reasonableness of 11-12% on the Nifty side. If you have to create value, then you have to do some degree of, like a mutual fund guy generates about 3-4% more. If you look at the S&P 500 has delivered about 13.5%. So point one, bull run. Please don't expect a bull run implies something like a 20% CAGR, which will not happen because you've lost the base. So I'm very thrilled to get 11-12% Nifty base return. And if you manage your portfolio right in that environment, can you make 14, 15, 16% compounded return on your entire wealth? The answer is yes. Point two, I personally think there should be an expectation of an investor, because of the global environment or any time so. All these bad speed breakers are the reason why you make 14-15% in equity. I will always pray that there are speed breakers, so that, because I have not earned all my life savings today. So please expect these speed breakers to give you buying opportunities, because more money is to be made by Indians ahead, not made already. So we are a young country. So if a 30-year man is being sad market has fallen, I tell him, how can you be sad that market has fallen? Because you have 30 more years of working. You're not a 65-year-old man. Why are you not celebrating that your future wealth can grow at a reasonable pace? So please see risks and impediments as buying opportunities. At 25,800, I was on your show, Karthik. I told that these are buying opportunities because you've already returned so much money to FIIs. So that's why you don't see sharp falls. And Globe news is not so good. I think one biggest risk which we have from the globe is not a trade war. Trade war is an opportunity for India. One big risk is, how would central governments, be it the Japanese central government, the Fed, how will they handle such kind of high interest rates which are not softening? Japan going to 1.5% 10-year paper is unheard of in this in the lifetime I have seen Japanese market. Those are the risks from the debt side which can spill to equity. Sorry for the longish answer.
No, that's fine, Feroz. Always welcome. And when you were talking about a return of 12 to 15%, 14 to 15%, Barnik sitting with me in the studio was nodding in disagreement. Barnik, what is your apprehension?
No, see, listen, I have a slight disagreement, not on the numbers, but on the philosophy, right? For an economy which is growing in nominal terms of 11 to 11.5%, 12.5% equity returns is not enough to justify the risk premium.
Because if you look at risk, जैसे our co-panelist Ashwin, right? Karthik?
Yeah.
Ashwin sir said, right? Risk is high. If risk is high, let's put the Nifty and S&P on an Excel sheet and measure the standard deviation from 23rd March 2020. Okay, India is not a speculative market anymore. Shorts are restricted. There are already few markets like South Korea has shorting restricted. India has had a short restriction of 500 crore notional. The S&P 500 has thrown up 60 bips more standard deviation than Nifty. So Nifty might represent 3% of the world's GDP market cap, and S&P represents almost 52% of the world's market cap. But it still threw up more risk. On the day when the trade war happened, Nasdaq and Dow Jones were down double-digit percentage. India was down 3.54%. Why did that happen? Because India is an investor's market, not a speculative market, because you have a 500. Second, PE might be high. I think PE is, to my mind, not a great barometer. You have to look at, you pay a PE because of the growth. If you look at PEG, India is one of the cheapest top 10 economies from a PEG perspective. Now coming to corporate earnings have delivered. Nifty earnings are 1,096 for last year. Of course, I expected 1,130. We are down 34 rupees. ITC came to our rescue. We did 1,096 on and still grew about 8.7% on Nifty on a very bad year. Our GDP numbers came at 7.4, which was 7.4, 7.5 for last quarter, which makes us, again, I'm not saying there are no risks. There is no impediment. There is more to come. There are so many things we need to fix from an FII becoming an India market. But risk is something most people are speaking in English. Look at the number, put the S&P 500 risk. So FII, if he speaks to me, I tell him, let's do the math. India might have a perception of a risk. You put that on an Excel sheet, get me beta, where standard deviation or value at risk. All these three are risk measures. All the three. Nifty throws up far better numbers than S&P 500 is my simple point which I'm making. Do the math and you will know perception on risk of India is significantly different than the reality of risk.
All right, it's a battle of narratives, perception versus math. Feroze Azeez, thank you so much for your time today.